Prescient Tom. I hope you don't mind, because this morning at 10:23 in the morning, you said possibly this is the flush. Bottom line, possibility equities reverse into the close. Well, it looks like you called it, Tom. What do you think about this reversal and what it means?
Well, I think if we think about the data for the past week, the stagflation story that gained a lot of prominence in the last 10 weeks, I think has diminished a lot. Because the jobs report showed good jobs, but soft on wages. We're making progress on the UAW strike. And then, of course, as you know, oil's come off that boil. And these are all pointing to an expansion that's not suffering from an acceleration of inflation. So I think it really helps the idea that, as you said, maybe the flush happened and we can be strong into year end.
Do you really think that this is that moment that that turn is going to begin to happen, Tom?
Part of the tactical view comes from Mark Newton, but I think it was going to be either today or early next week, because we had that intraday reading of the put call reach 1.97 only 20 times the last 30 years. It's so rare, but it has almost always signaled an imminent bottom. And then today, as you point out, we had a really hot jobs number, a pretty big sell-off that is reversing in the face of people still saying nothing's gotten better. So I do think the sellers are exhausted, and there's a lot of firepower on the sidelines. And if a few things go right, I think we get a big rally.
I know, but the one thing that's not really getting better, and I don't want to ignore it, rates are still high, right? So we're at 488 earlier today on the 10-year, so we're at 477. So we've come off, as you said, the boil, but we've still got a pot that's really simmering rapidly.
That's right. I mean, these are very tight financial conditions. It's probably not a long-term killer if we were at 5 for years, because we know 5% is the average for the 10-year for the last 90 years. But at the moment, that change has been very restrictive. If I was to be half full on this, we know this also means the Fed has less work to do, which means fewer hikes. So in some ways, as long as the market can absorb this change, and it's very restrictive, I mean, it's uncomfortable, I think that's positive. More importantly, as Walter Deemer pointed out, when you have a parabolic rise in rates, it's not going to take the escalator back down. If it does peak, it's going to be a sharp reversal, and then, of course, that's supportive for stocks. In the face of the Fed relentlessly raising rates, but in the next 12 months, they're taking their foot off that. Oil, I think, might have made a local top. Wage pressures went from, nearly 6% on their way to 3.5%. And a 10-year environment like this with nominal GDP does point to very good earnings growth historically, and the PMIs have convincingly bottomed. The ISM was stuck below 46 for several months, now back to 49. So to me, it's pointing to an economic momentum that's materially improving. So I think that rate of change is what's going to compel stocks to get PE expansion.
Tom, what do you make of weakness that we've seen in utilities and staples and transports and things like that? Are they any bit attractive? I know that all of these other sectors, the lights on the marquee, they're the ones that are there. I get it, but sometimes you see the best opportunities where the greatest amount of carnage lies within the market. Utilities, staples, things like that. Are they attractive to you or not?
Yeah, utilities. Look, for someone who's really great with timing, utilities, risk-adjusted, probably are huge opportunities. I mean, I bet you it's going to follow TLT, right? TLT at some point is going to make a pretty tremendous upside move if Mark Newton's right, and the 10-year goes back towards 4% next year. And on transports, it's tricky because you've got to pay attention to what's happening there, but there are a lot of interplay dynamics that are idiosyncratic and not necessarily simple macro. And then staples, I mean, it's tough because, that's a greedflation sector, and now it's on the margin some strange stories about, calorie consumption could be declining. I mean, it's tough. I think I'd rather own technology stocks over staples, because at least technology stocks, you don't have to worry about calories.
Yeah. I mean, I don't know that you'd find too many people fighting you on the idea of owning technology stocks over staples, so I don't know if that's necessarily a fair fight. But Bryn, how would you address those two sectors, or just simply other areas of the market that might work outside of big tech?
So I think going back to utilities and staples, we were looking, if you look at the net debt to equity of every sector in the S&P, which three sectors have the highest debt to equity ratios? Utilities, real estate, and staples. And so I think that those three areas, and so we're talking about two of them, are just much more susceptible to the D of the D and the E, right, to rate rises. So I think this is a unique time, typically later stage in the economic cycle, those would be doing well. We have a whole new playbook. I think that people can count on large cap technology to know what you're going to get. You might not get great revenue growth, but you're going to get good earnings because they're all buying back their shares. I think from an allocation perspective, what my concerns are is that I agree with Tom that the economy is probably going to stay really strong, but for the wrong reasons, because it's government-led. Because don't forget, we had the 1.9 trillion American Rescue Act, and then three other ones underneath them. Those dollars, Scott, need to be spent. There's billions and billions of dollars that need to be spent by 2025. And so you're going to continue to see municipalities doing very, very large infrastructure plans. And so bottom line what does that mean? That's good for the economy, but what else is that? It's inflationary. And so I just think we're in times where the government is spending like where they're trying to get out of a recession, and they're doing this pre-recession. And to me, that ends up causing just the higher probability that recession stays stickier because of government-induced programs into the U.S. And so to me, that puts somewhat of a ceiling on rates as well as markets, because we're going to continue to be having this inflationary conversation. We're not getting to 2% anytime soon.
Well, we seem to be on the march there. Tom, I think you'd probably disagree.
Yes, I mean, to the extent that I don't think it's a fait accompli that inflation is going to be accelerating or sticky. I mean, as we know, the only sticky part of core inflation right now is shelter, and housing is going to get walloped as mortgage rates stay here at 8. So to an extent, this rise in rates is accomplishing what the Fed wants to do, which is kind of put a ceiling on home prices for now, and that's going to really restrict CPI. I mean, 40% of core CPI is basically housing related anyways. Autos, that makes it close to 57%. So as long as cars and housing aren't accelerating, inflation is on a glide path lower.
Tom, what's your target for the end of the year for the S&P? You still have one, correct?
Yes. Scott, I think we're going to rally double digits, so I think we're going to get over 4,800 by year end. I mean, a lot has to go right, and I'll tell you, there's a lot of damage in the last few weeks, so it may not get to 48, but I think directionally is correct that I think we have a very strong reflexive recovery because interest rates are nearing an end of a parabolic rise.
Wow. Well, we'll see for sure, and we'll talk to you plenty of times about it. I appreciate it, everybody. Thank you. Bryn, we'll talk to you soon.